they've been called as financial weapons of mass destruction by no less than Warren Buffett, the famous US investor. Politicians in Europe seem to be obsessed with trying to ban them in some way. They certainly like to criticize them, and every time you hear the word Greece, you'll hear the word CDS not far behind it. So what are they? And actually, should investors worry as much as some people would have them worry? So credit default swaps, this video is going to look at what they are, who uses them, how they're priced, and what that can tell you about the chances of, say, a country or a company going bust by looking at historical CDS prices versus their current CDS prices without worrying too much about the technical details. Okay, so let's have a look at one. Let's take a look at this thing called the credit default swap. The best way to think about it is as an insurance policy, but one that can be traded. So what did all that mean? Just like you buy home insurance to protect your home against, say, fire or earthquake, the same way you buy car insurance to protect your car from accidents or thefts. We pay an upfront premium in return for compensation if something goes wrong. Credit default swap, CDS. It is a way to insure your investment portfolio. Now, what did I mean by tradable? So, you cannot sell your home insurance or car insurance to someone else, unless, of course, you are selling the underlying, that is, home or car. Even in that case, you can only transfer insurance to new owner but cannot sell it. But in the case of CDS, you can sell CDS just like you sell your shares to other investors, or a closer resemblance is, say, options or futures on your shares. So you can sell futures on your shares without having to sell underlying shares. Similarly, let's say you bought CDS to insure your investment portfolio. But then, say price of CDS increased quite rapidly and you want to benefit from the increased price of CDS. Then, you can sell it in OTC market and make profit without having to sell your underlying investment portfolio. Although, now you will be left with no insurance on your portfolio. But hopefully this made-up scenario clarified what I meant when I said CDS is like a tradable insurance. In the investing world, big institutions, rather than you or I, can insure their bond portfolios. What do they want to insure against? The risk that the issuer, the person who sold them the IOU, if you like, goes bust. And that's where CDS has come in. So typical scenario, our investor A and investor B could be an institution, a fund manager of some sort, and they've gone out and they've bought a portfolio of bonds. Now there are other videos on bond basics, so I won't cover them again here. But do take a look at that other video if you're not sure. But a bond is essentially an IOU issued by a company or a government. And CDS market is bit more wide and liquid for what are called sovereign bonds. That's IOUs issued by the country's government. Why? Because they needed to borrow money. So institutions in the financial markets are prepared to lend governments that money by buying up their bonds. So far, so good. Okay, so where does a CDS come in? Well, there are two risks with something like a bond or a share or any kind of investment, really. Number one, it can go down as well as up. There's price risk. CDS don't do anything about that. However, CDSs, like insurance policies on cars, do something about the catastrophe, the default risk, okay? Think about it. When you insure a car, the value could go down or up, and you may never need to claim on the policy. The insurance policy is irrelevant to what you sell the car for. Same with CDSs, they're designed to protect against some kind of catastrophe. What would that be in the bond market? It would be an, for example, issuer going bust. So, where does a CDS fit in? Basically, let's bring in another player, an investment bank. And basically, the nervous investor, the investor who's got these bonds, is thinking, well, I suppose I could dump them all, but realistically, who's gonna buy them? Besides which, I don't really want to dump all my bonds because they pay an income stream, a coupon, so maybe dumping them wouldn't be that sensible because what would I replace them with? So, and also if I sell my bonds, some of them might even trigger a kind of capital gain of some sort. So, really, for tax purposes, maybe I want to hang on to them. So, as an investor in bonds, you might be sitting there thinking, well, for various reasons, I'm happy to hang on to the bonds, or I may feel I have no choice but hang on to the bonds, and I want some kind of insurance policy. So, the credit default swap would work something like this. The investment bank says, right, okay, here's the deal. This is a kind of insurance policy if you like, so you pay us a premium, which you're not going to get back. Now, the investor's going to be paying this, maybe upfront, but more typically, it's paid sort of in installments on a kind of pay as you go basis, maybe over, say, 5 years, and in return, we'll offer you some form of protection if, and here's a piece of jargon you see in the press a lot at the moment, there is a credit event. Now, we'll talk more about what that might be in just a moment. That is quite a source of debate right now. What are these credit events that could trigger a payout by the investment bank that sold the insurance policy? So, in simple terms, a CDS is bought by someone looking for protection against, in this case, bonds, a portfolio of bonds, and sold by an insurer. And what is the protection? Well, that can work in several ways. If a credit event takes place, what the investment bank might do is say to the buyer of the insurance policy, I will take all the bonds off you at what's called their nominal value. So, I'll sort of guarantee a price for those bonds in effect. And again, nominal value is something I talk about more in my bond basics video, for anyone not sure about that. In effect, the bank's saying, I'll give you a sort of guaranteed value for those bonds, and you just give me whatever they're worth when the credit event takes place. Now, given that a credit event is some kind of default, it's bad news. Chances are they're not worth very much at that point. So, it is an insurance policy. So, like all insurance policies, the issuer would like to just collect the premium and, frankly, not have to worry. Just go out to lunch. Like your car insurer would like you not to crash your car and just pay a premium, and then they've done something for almost nothing. The investor would probably prefer not to have to claim on the policy, but if a credit event takes place, they may need to. So, next issue, what is a credit event? Well, that's a good question, and there's much debate about this at the moment. Typically, an easy credit event would be a default of some sort. So, for example, one of these bonds suddenly doesn't pay its coupon, or worse, it gets to the redemption date, and the issuer simply can't afford to pay it back. Or the issuer just goes bankrupt, and all of its bonds become suddenly under threat. So, most people would understand that one, but it can get more complicated because credit events can also cover restructuring, and that's where there's a bit of debate at the moment. For example, due to war situation in Ukraine. If a lot of Ukraine bondholders are thinking, well, these Ukrainians are not going to pay us back on time, they just can't afford to, the government can't afford to pay back on time. Maybe what we'll agree to do voluntarily as investors is essentially roll over our investment in the dodgy bonds issued by the Ukrainian government into less dodgy bonds issued by the Ukrainian government with some longer maturities, and so on. The question that's being debated at the moment, which I don't have an answer to, is would such a restructuring, a voluntary restructuring, constitute a credit event that triggers loads of insurance payments under credit default swaps or not? And that's an issue you'll see debated around Europe just now. Okay, what can credit default swaps tell you about what's going on in the market? And the answer is they can give you quite a good insight into what the market thinks about the chances of, say, an issuer or an entire country going bust. So let's take a quick look at pricing next. Now, the detail of credit default swap pricing is quite technical, but the basic principles are not. First of all, there's one thing you need to know in order to understand the price of CDS, which is the market likes basis points. In other words, you get credit default swaps quoted as 50 basis points or 1,000 basis points. You might think, well, what does that mean? I mean, normally an insurance policy is quoted as dollars. Well, basically, you can turn basis points into dollars or pounds or rupees because one basis point is 1/100th of 1%. Okay? So on that basis, 100 basis points is 1% and 50 basis points is 0.5%. So if someone were to say, right, how much is this credit default swap? The answer might be 50 basis points. And what would that mean? That would give you an indication of the sort of annual fee that the buyers got to pay the seller. And the way it's done is it's expressed as a percentage of the amount of insurance cover. So what that means is imagine you take a contract that covers a notional amount of 10 million US dollars of bonds. In other words, it's insurance on $10 million, nominal value as it's called of bonds. And the price is quoted as 50 basis points. Basically, the higher this number, the more expensive the insurance is. How does that work out? Well, we said that basically 50 basis points, and we know that 1 basis point is 1/100th of a percent. So 50 basis points is 0.5%. If you take 0.5% of $10 million, you get $50,000. So what we're saying is that CDS is going to cost you $50,000 a year at a price of 50 basis points to provide insurance on 10 million US dollars of bonds. So the higher the basis point quote, the more expensive the insurance. Now these are figures I just plucked out of the air. So what actually does it cost at the moment to insure the bond? Well, to give you an idea, just before Lehman Brothers went bust, the cost of insuring its debt, if you held it and wanted insurance, was around 1400 basis points. So that's rather a lot higher than the 50 basis points example I've got here. So that whacks up the premium. If you're still talking about $10 million worth of bonds being insured, a premium of 1,400 basis points would translate into $1.4 million rather than just the 50,000 I mentioned there. What about Greek, Portuguese, and Spanish debt at peak of European debt crisis of 2012? Well, let's have a look at some prices. In 2012, the cost of insuring Greek debt is in excess of 2,000 basis points, right? Another way of looking at that is you are paying as a premium annually 1/5 of the value of the debt in question. Who else is the market worried about? Well, that's Greece. Here are some other numbers. 850 basis points. That's Portugal. So again, it's cheaper to insure Portuguese than Greek. Look at another couple of countries on the sort of the hit list if you like. For Spain, the number's around 300 basis points, and on the sick list, you've got Italy around the 220 mark. Now, what exactly that means in dollar terms is less important than the principle that Greece is obviously well up at the top of the sort of critical list at that moment, followed by Portugal, followed by Spain, followed by Italy. Now, you don't have to agree with the CDS market's view of who's most likely to go bust, but CDS prices can give you a bit of an insight into what the market thinks might happen next. Fast forward in 2025, let's look at CDS prices now. There is this easy to understand website that collects information from various sources and aggregates it and present it in a very readable form called worldgovernmentbonds.com. Now here, if you look at Switzerland, which is a AAA rated country, cost of CDS on its 5-year sovereign bond is 8.53 basis points. Whereas if you look at Canada, for example, again, it is also a AAA rated economy, but due to its tariff issues with USA, also referred to in the media as economic war, the cost of insurance has gone up as it is much more risky than a Swiss bond. So you can clearly see that CDS markets are ahead of credit ratings, as in pricing is more dynamic, and it reflects true economic situation than a credit rating. Let's validate it with few more examples. China, which is currently in a massive tariff war with USA, and literally USA has banned imports from China by applying more than 200% tariffs on Chinese products. Even though it has an A+ rating, it is quoting 59 basis points, which is higher than some of the lower rated countries like Spain, Italy, and Greece. By the way, now that the European debt crisis is over and behind us, you can see Spain's CDS cost has gone down from 300 basis points to just 36 basis points. Similarly, Italy's CDS cost has gone down from 200 to 56.7, and that of Greece has gone down from 2000 to 58.7. Let's end it with one more insight. As we know, Israel is also in a sort of war. So even though it enjoys a credit rating of A, but cost of its CDS is 104.97, which is much higher than that of India and Indonesia, which have lower credit ratings than Israel. So in essence, we can see that CDS market is much more closer to current realities than a credit rating market is. Now next question, politicians, and we'll finish on this one. Politicians have been talking about banning speculators, banning CDS. So how much trouble are they? And the answer is really politicians are in one way using them as an easy scapegoat. They're saying, here's this mysterious instrument that no one fully understands, so we'll blame that, right? Rather than the fact that under them, their countries might have overborrowed, overspent, or gone into wars, and their economies are no longer as strong as they were once. In other words, the politicians will always look for somebody to pin the blame on when actually the blame might lie with them or the people they represent. Now, the problem with the CDS market is it's difficult to get information. These are private over-the-counter deals between large institutions. They're kind of shadowy. It's quite difficult to get raw, accurate data on how many of CDS are live against a particular issuer, especially when you get into kind of the corporate bond market instead of sovereign bond market. But nonetheless, the DTCC in the US, the big clearing organization, had a go, and it said that really the CDS market is quite small. For example, at the peak of European debt crisis, the total outstanding insurance on Greek debt via CDS is around 4.04, 8 billion US dollars, in a market for Greek government bonds worth $500 billion. Okay? So on that basis, you're talking about quite a small market. So would banning it make much difference? And secondly, do speculators really cause the problem? There are some people around who would say that actually, if speculators had been allowed to operate more effectively earlier on, if short selling hadn't been banned, speculators could have driven up the cost of Greek debt much quicker. That would have forced the Greek government to rein in spending much earlier because it couldn't have borrowed on such competitive terms, and that would have forestalled the current crisis. In other words, there might have been a crisis, but it would have happened earlier, and it would have been smaller. But the problem the CDS market has, and it's its own fault, is it is quite murky, it's quite shadowy. It's been labeled as financial weapons of mass destruction. So a little more clarity and transparency would actually help the market and perhaps remove some of the accusations that are flying about what it does and exactly what it's responsible for. Alright everyone, that's all for this video. If you liked the video, then please do like, share, and leave a comment on it, giving us your valuable feedback. Also subscribe to our channel for more such videos.